Hey, what's happening, options traders? And good morning, everyone. And I wanted to take a new look at an old topic. Let's take a new look at taking quick profits, because I still hear that a lot from some of our traders. I get it in emails and in coaching calls. People think that it's a good idea to just take a quick profit. As soon as you have any sign of a gain, you might as well take it. And the problem is, as I've pointed out in other videos, that will ultimately lead to losses. And I have another video in our forum called You Can Go Broke Taking Profits, talking about this very thing. But we're going to do it from a different perspective this time. So for anyone who thinks that you're better off taking profits at the first sign of a gain, let's take a new look at that idea. So the main reason that traders fall into this trap is that quick profits seem like you're reducing risk. You'll say, look, I'm up 10% or 15%, and yes, I might make more, but if I continue to hold it, I might lose my profits, and worse yet, I might even lose some of the principal. So let me take it off the table. Now, the first problem with this idea is that who's to say that the new trade that you put that money into is going to be any safer? Just because you exited one trade successfully doesn't mean it was a good idea. But again, the reason that traders do this is they say, oh, well, you can't go broke taking a profit. And it's definitely the worst expression on Wall Street. And once again, I do have a video saying that you can go broke taking a profit. You've got to get this thought process out of your head. But still, traders get this idea of taking many small profits. And the problem is, if that becomes your goal and your philosophy, you're going to be clipping these trades at the first sign of nickels and dimes, but you're always exposed to potential large risks. And yeah, I know traders say, but you don't understand, I watch it closely. Well, what has that got to do with anything? Are your eyes going to prevent a trading halt in the middle of the day and prevent that stock from gapping down 30% once it starts trading? Of course not. You can watch it as closely as you want, and there are certain risks that you just can't prevent. So let's take a new look at why taking these very small quick profits is simply a bad idea. So let's do it with maybe a digital seesaw. Let's put two kids on a seesaw. So you may remember from basic physics classes that if these kids are the same size, that we will balance right here in the center. That's where we need to have that balancing point, or what's called the fulcrum. And we could get them to actually sit horizontally like this. And that's because they are equally sized. And if that's true, the distance from this balancing point will be the same. So if this first kid is 1 foot away, the second kid can be 1 foot away, and they will balance. If the first kid is 5 feet away, second kid will also have to be 5 feet away. That's what I mean by a 1-to-1 ratio. They have to be the same distance, and again, that's because they have the same size. And that's going to be important for understanding when we talk about weights of a probability distribution. All right, so now let's change it a little bit, and let's say that instead of having these kids the same size, one is twice as big as the other. Well, if you do that, you can't balance at the point that is dead center between them. You need to move your fulcrum closer to the heavier kid. All right, so we have to slide over this way a little bit. The question is how much? What will these new ratios be? Well, it turns out that the distance that this first kid is to the fulcrum, the second kid must be twice as far. And once again, that's because the first kid is twice as heavy. So by being twice as far, the second kid over here gains some leverage, and that's what's causing it to balance. It's got to be in a 2-to-1 ratio. If this first kid was 4 times as heavy, the second kid would have to be 4 times further away. It would be in a 4-to-1 ratio. All right, so keep these points in mind because they are super important for understanding what we really mean by an average and when we look at weights. So let's now go to numbers. Let's take two numbers, let's say 10 and 2, and if we add them up, we get 12 divided by 2 is 6. That's our average. But we could also look at this as a seesaw. I could say I've got one kid sitting at 2 and one kid sitting at 10. Don't think of one being 5 times heavier. That's not what this is saying. It's one person sitting at this position and one person sitting at this position. They are the same size. I have 1, 2, and I have 1, 10. And because of that, we could balance right there at 6. And notice the first kid is 4 units away. That's going from 2 to 6. And the second kid is also 4 units away, going from 10 to 6. They are still in a 1-to-1 ratio. And that's because this is the average. The average is the balancing point. And again, that's going to be really important for understanding why you can't take very quick profits. All right, let's make it a little bit more difficult. Let's put 3 numbers up. Let's do 2, 6, and 10. And what I want to show here is something really interesting. Now, the first thing is the average. 10 and 6 is 16, plus 2 is 18 divided by 3 would still give us an average of 6. And so because of this, we could technically put 3 kids on this seesaw. 1 at position 2, 1 at position 6, and 1 at position 10, and we would be in balance. But what I want you to see now is let's just look at this range over here as its own separate seesaw. If I have 1 kid at 2 and 1 at 6, where would they balance? They would balance right here in the center at 4. So mathematically, we could pretend that we have 1 kid at 4 who happens to be twice as heavy. And we can still balance here. Notice at the balancing point, this kid is 2 units away, going from 4 to 6, and the second one is 4 units away, going from 10 to 6. But now they are in a 2-to-1 ratio again. Why? Because this first kid is twice as heavy. And that's what's causing us to balance right here at 6. So when I talk about the average, I want you to really understand it as a physical balancing point, just like with a seesaw. All right, now with those points in mind, let's take a look at our friend the bell curve. And what we're looking at here is a certain volatility, which remember gives us a range of potential stock prices. That's what volatility shows us. And if you were to look at this as a seesaw across the bottom, where is the balancing point? Now don't let the higher center and the lower tails fool you. They are just different weights. So look at it, because it's symmetrical, we should balance right here. And that means half the time we should be into profits here in green, half the time we will be in losses down here in red. But watch what happens if you change your philosophy and say, I'm never going to let these profits run. I'm going to take very quick, fast profits. What does this half of the bell curve look like for you now? It's not here in green because you're not allowing it to run out here. It's going to look something like this. As soon as you move from, let's say, 0 into profits just a little bit, you're taking your gains. So from your perspective, where is your seesaw now? It's from the right edge of the green all the way out here to this left tail. And where is the balancing point? Yes, we have a lot more weight here near the center, but it's going to be somewhere in here. But it doesn't really matter where it is. The fact is you are balancing in the red. You absolutely, positively must be in the red. Because if you are stepping into trades that have this type of a distribution, potential for gains and losses, but you're not letting them run any further than this little sliver right here, you absolutely must be balancing here in red. And that is just a mathematical fact. It's not a matter of opinion, it's just a matter of time. You will eventually see that this has to be true. So now think about the benefits of options. Here's our risk graph for a call option. What do you notice? It's already limiting the downside for you. It's giving you unlimited upside. And yet what do people do? Well, I bought this option for 3. Let me sell it for $3.30 because I've got a 10% gain, and after all, you can't go broke taking a profit. And all you're doing is leaving still a disproportionately large downside relative to the upside. So that's why I constantly tell traders, get the expression that you can't go broke taking a profit out of your head. Think about another Wall Street saying that says, cut your losses short and let your winners run. And that's why that expression came about. The professional traders know that you've got to let those profits run. Now the way that you do that, we get a lot of advantages with the options because we can hedge, roll, and morph. And that exactly allows us to manage the risk to the downside, but still maintain higher potential for rewards. And how you do that, I've talked about in many videos and will continue to do so in the future. But for right now, I just want people to get it out of their heads and to understand that it's a bad idea to take a very fast, quick profit, especially if you think that you're not going to go broke doing so. So for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new technical analysis course. You can find it all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.